What's good, gang? My name is CJ Soup. Today, I'm going to be teaching you how I use time in the futures and the Forex market. Now, where do we get this concept of time? The basic concept of time comes from ICT, where it talks about that time is more important than price, which is absolutely true and critical. I'm sure you've been on Twitter and you've seen Turtle Supers taking these crazy RR trades, bottom and top ticking the market. And I'm sure you've wondered, why was it that old high? Why was it that old low? That was the actual Turtle Soup that gave a crazy RR trade. It all comes back to time. Foundationally, we were all taught the ICT kill zones. London kill zone, New York kill zone, a specific time interval within the day that you can expect a setup to present itself. But there's actually a logic behind time that I'm going to share with you today, and it will be the most important factor within your trading. So let's get it. Okay, guys, so it's currently the next day that I'm recording the actual content, the actual value that you came here to get from this video. This is the part of the video that is not going to be flashy. It's not going to try and keep your attention. This is the nitty gritty, the meats and potatoes of why you're here to learn how I navigate these markets. These components that I'm about to teach you, specifically time, is the most important thing in these markets, and it's how price actually moves. If you do not believe me, then watch to the end of this video, take notes, be diligent, and go find examples in the charts. It's there every single week in one form or another. Now, there is a prerequisite to this information. If you haven't gone through the ICT core content, then some of this information might be a bit over your head. So this is more for the intermediate to advanced ICT trader to understand these concepts. It may seem very simple from what's on the screen. Just 4 order flow time, higher time frame, key level Turtle Soup, bro. Oh, that's it. But it's the logic. I'm going to be going through an example here in a bit after I go through the actual theory side of it, the whiteboard books theory, and then we're going to get into the practical shit, and I'll show you how EU, Euro, USD actually went by these principles last week for the main weekly move. So the components of a high quality, high probability setup. Firstly, you need order flow. You need to identify what is price rejecting. Is price rejecting highs or is price rejecting lows? And then is price breaking through highs or breaking through lows? So you want to think of it as price is rejecting lows and breaking highs, meaning it's bullish, or price is rejecting highs and breaking lows. You need to be able to identify this in the chart. Time, the time aspect. What do all the Turtle Supers on Twitter mean by time? I keep seeing this time. What do they mean? What do you mean by time? What is time? Like, I understand, like the kill zone, like New York open. No, time means open high, low close, open low, high close. How a candle forms. But then the key word after that, fractalized. Fractalized. We trade candlesticks. Almost every single candle has a wick on both sides of the candle and a body, obviously. Which means when a candle opens, it will open, high, low, close. That right there is how a candle forms. Imagine this to be one full bearish, low-key doji candle. Imagine that's what it is. That's how a bullish candle actually forms in the chart. Now, so how can you use that within the market in order to predict price? When you fractalize it to a higher time frame candle, meaning the weekly, the daily, the 4-hour, depending how the candle opens, you can normally predict what the candle's going to do strictly by the open. If you're talking about a 4-hour candle, seeing what it does in the first 45 minutes until the second macro of that 4-hour candle, you usually know what's about to happen for the next 2 hours. Most of the time, whether it's going to be a continuation or if it's going to be a straight reversal on the 4-hour time frame. Now, when you fractalize it more to the daily and the weekly time frame, that's where the sauce is, bro. That's where the big moves are, bro. Okay? So we're going to get to that. So let me just continue, and then I'll show you in the chart exactly how to implement these concepts, right? Next, you need a higher time frame key level. Price isn't just gonna open, go high, just reverse out of fucking nowhere, and then go low, and then that's your distribution to catch and get your 50 to 100 pips. No, price has to hit some sort of key level. What is a key level? An order block, a fair value gap. That's what you consider a higher time frame key level, or a breaker, or a mitigation block, or a propulsion block, all the other things. But bread and butter, meats and potatoes, order block, fair value gap. Because if you don't know, a breaker block is just an order block on a higher time frame. Well, the breaker block is on the lower time frame, and it's just an order block that's on a higher time frame. If you don't know that, go look. Okay, so you need a higher time frame key level. That is what's going to actually initiate price to reverse. When we're trading, we're trying to catch reversals. We're playing the risk to reward game. It's good to have a high win rate, but if you have a high win rate and you're only getting a reward of, say, 10 pips, whereas you risked 50 pips, you should already know this by now. That's not going to be consistent. We're playing the risk to reward game. So we're trying to catch reversals. We're trying to catch levels in the market where you expect price to reverse so you can have a small stop loss and a big reward. Now, that also takes me back into time. What we're trying to do here is have a lower time frame risk for a higher time frame reward. That's the name of the game. That's what we're trying to do. So what do you need to do in order to have a lower time frame risk and a higher time frame reward? You need to have time frame alignment, time frame correlation. Everything needs to correlate. If you're trading a daily candle, you want to base it off of the weekly. You want to base it off of the weekly open high or open low to then catch a reversal, which is then the distribution of the weekly time frame. You understand what I'm saying? And then you fractalize that down even more. So you're entering, say, on the daily, but then you fractalize it even more to then catch a weekly distribution. Now you're on the 4 hour. And you can fractalize a higher time frame key level as well to a 4 hour key level that is within a weekly key level or a daily key level, and then fractalize it even more. Find a key level within the 4 hour candle or on the 4 hour time frame on a 1 hour time frame, and then you fractalize it even more, and then you take it from the 1 hour, you can go down to the 15 minute. But when we start going below the 1 hour, at least for me personally, I don't start looking for like 15-minute key levels and I put my stop loss based on that. No, I do still put a little bit of space, but it's more I look at candle behavior at that point. So either I'm trying to see if there's a lower time frame turtle soup within the higher time frame key level, which I then use as a stop loss. Because if it's a valid turtle soup that is a protected high or low, price should not return there. Which brings me into the last point, turtle soup, aka liquidity. Price needs to take out an old high or an old low in order to fuel itself, grab stop losses, grab liquidity, grab capital that's floating in the market in order to reverse, to go the other way, to get the other people's liquidity. You understand? That's how the market moves. It's just trying to attack liquidity. It trends, it goes a certain direction in order to correlate with the high time frame macro news that's happening in the world. But while it's doing that, it's trying to get everybody out of the market that's trying to capitalize on this macroeconomic news. It's trying to get all of their money first while we're trending. You see what I'm saying? So those are the 4 components that you need for a high quality, high probability setup. Now, if you didn't take fucking notes in that, bro, like I don't know, bro. Like I don't know. That is probably the most sauce you will get. Now, where I learned this stuff, I can't discuss. And some of the time aspects that I'm about to go into when it comes to the examples, or I guess a main example that I'm going to go into right now to make this more practical so you can actually see it in action, so then you can do it for yourself. I can't go into every little itty gritty of the time because it's a bit too saucy, bro. Like, that's not me trying to gatekeep this and that. Well, I mean, if you want to fucking call it that, I don't care. But like, it gets real saucy. But what I'm telling you right now is all you need. It is all you need, though. Trust me. It's all you need. You don't need any other shit, all right? One day in the future, I might come out and talk more about the time aspect of things. But for now, just know that time means open, high, low, close, open, low, high, close. And correlating that between all the time frames. That's time. That's time, right? Okay, one more thing I'll say just to drive home the time. if you know basic math, right? And you know a graph, you have an x-axis, you have an x-axis, and a y-axis, right? Now, if you know anything about time, if you know anything about a normal graph in basic math, the x-axis is the independent variable and the y-axis is the dependent variable. Okay, hold that. What is the chart that we're looking at? The x-axis is time and the y-axis is price. Time is the independent variable. Price is the dependent variable, meaning that price is dependent on time. And that's why ICT came out and said time before price. But mans didn't truly go into like, okay, but like this is what I actually mean. And I'm telling you what it actually means. So if you have a higher time frame key level, if you have a key level, which is price, a horizontal line on the chart at a different price, talking about a different y-axis variable, it will only work if if a vertical line on the x-axis is at the correct point. And that doesn't just mean kill zones. It doesn't just mean a time interval. It means a specific higher time frame candle has opened and then went low or high into the key level. If you don't take notes on that, bro, you're done. You're done. I don't care, bro. You're done, bro. Please take notes on that. Go study it. Back test it, bro. Trust me. Just trust me on this. Yep. Okay. So now we're going to go into the next section of the video where I'm going to be going into an actual practical example of how Euro USD moved last week. Okay. So I was actually going to mark out everything that I wanted to show you, but I think it would be a better learning experience, a lot more digestible if I go through all the marking up as I'm talking through it for you to learn. Okay. So I'm just going to do a run through it, take as much notes as you can, listen to every single word that I'm saying. Stuff might be a bit of a ramble, whatever. Just make it coherent in your notes. Just make it coherent in your notes because it all will make sense. Okay. So firstly, and also I'm doing it on GDP, USD, GU instead of Euro, just because the higher time frame key level is a lot easier to see. So the concept itself looks a bit cleaner for education's sake, though EU did do the exact same thing. It did have a key level, but this key level on GU is a lot cleaner. Okay. So first things first, what are the components of a high probability setup? Order flow, time, high time frame key level, liquidity, aka turtle soup, right? Boom. These concepts right here. Okay. So here we're on the GU weekly chart, right? We're going to be going over last week's price action, which is this weekly candle right here. So last week, Monday or Sunday, you would have woke up and you would have seen this. You would have seen this chart and you're trying to predict where is the next weekly candle going to go? Where can I enter the trade and catch the meat of the move? Right? So, what's the first thing? Order flow. What's the order flow? What is price doing? Where is price coming from? Where is it still heading? So, as we can see, price went above this high in the past, went above another high, and then rejected and closed below. Here, pushing through this low, meaning that it's breaking through a low. Okay, cool. So we got that. All right. So let's look to see what it does at the next low. When it approaches the next low, what does it do? It breaks through the next low. Okay. So I'm starting to see some bearish confluences right now. It's breaking lows right now. Okay. And then we see for a couple of weeks that price starts heading back up. Is it breaking through highs as it's going up right here in this little consolidation zone? We can see, no, it's not. Price is literally closing within the previous candles, indicating that it doesn't want to continue pushing. There is no momentum for the continuation in that direction. So you can anticipate a reversal. And what did it do? Reverse to again break through a low. So we can conclude from our hypothesis that price is rejecting highs and breaking lows, aka we are bearish. So we're looking for shorts. We're looking for shorts only. We're not trying to trade counter trend. We're not trying to get caught up in fucking consolidation. We're not some fucking irresponsible gamblers just taking random trades because I need to get the fuck in the market. No, we're not doing any of that shit, all right? You wait for it to be clean. You wait for it to be clean, right? Okay, next point. What's the next point? Point number 2, time. What is time? As I explained before, time is an open high, low close, open low, high close. So from the order flow, we have concluded that we are bearish. We're bearish. We want to take shorts. We are predicting that price is going to continue lower. So what do we want to see first? We want to see the weekly candle open high. So then we can catch the high to low and then close. Okay? So where's the weekly open? The weekly open was here. That's the weekly open there. That's where the weekly candle opened. Okay. Now, we will go back into the time because now we need to intertwine the higher time frame key level with time, which is time frame alignment, going further and further down the time frames. Okay, so if we are predicting an open high to occur, what is the closest key level that we can expect price to reject off? What did I say before? A PD array, a fair value gap, or an order block? What can we see in here? We can see a breaker on the weekly time frame. We can also see an order block right there. Boom. Well, that wouldn't be an order block. It would be a propulsion block, technically. It's an up close candle that didn't specifically take out liquidity, though it was a previous weekly bearish fair value gap. That price entered here, rejected, and now price is going back up to retest the third candle of the fair value gap, which was an up close candle, making it a propulsion block. What is the most sensitive part of an order block / propulsion block? The opening price. The opening price of an up close candle is the bottom border of the body, right? Price goes up, taps that, and we can see that's where the main move came from. Now we're going to go down the time frames. Okay, that's the key level that we're expecting price to hit. Now if we go down to the daily, if we're expecting an open high, low close, what days of the week would we expect the open high to be occurring on? The first half of the week. Monday, Tuesday, sometimes Wednesday. But most of the time, Monday or Tuesday. And I like to bet Tuesday most of the time. I'm sure you've heard about that from ICT's core content when it's talking about weekly and daily profiles. This is why I said that this type of information requires you to have already learned the prereqs. You need to be a master of ICT concepts already in order to then be able to comprehend this information, right? So we got the weekly higher time frame key level there. Okay, now we're on the daily. So this is the weekly open here. This is the Monday, right? What do we expect Monday to do? We want to see it open high. We want to see it open high into the weekly key level. What does it do? It opens high, right? Are you taking trades within the Monday candle? When you get more advanced and can anticipate price heading to a certain level before the actual move, yes, you can trade the bullish moves up to it, right? Like, why not, right? I want to give more sauce. There's something that's going on in here that you can expect that price wouldn't go above this swing high here, which would also indicate that this is a good key level to pick on the weekly time frame. But I'll save that for another video, right? So that's the daily. We'll move further on down to the 4 hour. This is when you can see a bit more of the guts of the move, right? So you got the weekly open. Monday, opening high, rushing into the key level, speed into the key level, faking everyone, trying to tell everyone we're bullish now. We're going higher. Everyone get in longs. When, no, we're still bearish, like we assumed before. Always trust the trend until you don't. So what happens? Price goes up on the Monday, stops short of the key level. Here, stops short of the key level. Starts going lower. Faking some people to go short. So, what is price doing? Generating liquidity. That's why it stopped before the key level. Generating liquidity. Because price came up, starts going back down, trying to tell everyone, oh, like this is where we're going back down now. Everyone get in shorts, get in shorts. And this is where a bunch of price or a bunch of liquidity is being accumulated in this area here. But what you're going to anticipate, because you have the information now from this video, that you're going to anticipate that price is going to turtle soup, liquidity sweep into the key level itself, which is exactly what happened on Tuesday. So Monday, got up close to the key level, did not tap it. We're not chasing price down here on New York Open. Oh, it's going lower. Here it is. I'm going to miss it. No, we're waiting. And if you miss it, you miss it. Do not care. It is what it is. You're going to miss trades. It's fine. You'd rather not lose money than lose money, right? You'd rather just be out of the market. Okay, so anyway, so then we come to Tuesday. We can see that Tuesday sweeps Monday's liquidity into the key level. And we're anticipating this key level here. Now, sometimes the weekly key level, say, is here. Sometimes price will want to hit the key level, go through the key level, go back out of it, back into it again, maybe chop in there a little bit, and then soup, and then go. Sometimes that's what price wants to do. In this case, it's a very clean one. It's a very clean, stops before the key level, soups into the key level. So this is a very clean example. Sometimes it can be a bit more messy like that, but you're still anticipating the reversal to occur somewhere in here. And how do you know which one is going to be? Wait for a liquidity sweep. Where is the liquidity sweep? There. That's it right there. And then it even comes back up to retest, creating a failure swing, which can also be considered an SMT sauce. I'm going to stop that there. Sauce. And then that's where you get in, right? Okay. So let's go further in. So recap. What do we have? We have order flow, bearish, breaking lows, rejecting highs. Next thing we have time, weekly open, opening high when we're expecting a continuation of a bearish week. We're opening high until where? Now that we have the x-axis, we want the y-axis. The y-axis, price. Price being the key level. Where is it going to reverse from? We have a weekly key level. The higher time frame, the key level, the more potent it is, the more strong it is, right? That's why we weren't shorting this 4-hour order block. It got fucking ran through, right? Because we want the higher time frame key level. Okay, stops before there, right? To generate liquidity. Liquidity sweep. We now have the liquidity sweep, the fourth component. And we're expecting a bearish week. It's Tuesday. We still got 3 more days of the week. I think this is a perfect spot for us to continue lower. And what happens? We continue lower. And that's basically it. And that's how the market moves week after week. Now, let me show you how to get a solid entry. Like, this is already a solid entry, right? Because you know that price stopped before and accumulated. You can anticipate as soon as we soup even just a little bit into the key level, that's going to reverse. So you see it go up, you see it hit it, get in, maybe 10, 15 point stop, whatever, aiming at the other opposing end of the range. A 14R trade that hit the next day. But since you're trading a weekly range, you can expect it to continue. So you could have held runners. Sauce. Anyway, so let's move just the last thing onto the lower time frame. How can we a bit more sniper it? Whatever. If you want to sniper it. So we're anticipating this liquidity to get swept into the key level. What's one indication that you can get in? Well, one just from basic price action traders would say, doji candle, a hammer candle formed. All these retail concepts that we're taught not to learn, we trade ICT, they actually do work. If the logic is there, if the ICT concepts align with it. ICT and what I'm teaching you right now is how the market actually moves. But retail concepts still work. There's still profitable retail traders, correct? Right. Because if it aligns with this logic, then it's correct. So that's one indication on the 1 hour. Going further down to the 15 minute, which is the last time frame I'm going to go down to. If you go any lower than the 15, like sometimes I go on the 5, but it's just not worth it, really. It's really just not worth it. So what's the indication here? We can see a clear lower time frame liquidity sweep fractalize from the higher time frame liquidity sweep. So as soon as you see this sweat, right? You see it hit, reject, boom. You see it reject right there, close, you're in. You go through like an hour of like tipping and drawdown, whoa, but you don't get scared. It's what you anticipate, and then it goes. If you're a pussy, whatever. This is where the ICT 2022 model actually fucking works. Go down, market structure shift, go back up, soup into a higher intermediate time frame PD array being a fair value gap, reject, closes back inside. There you go. If you want to be safe above this fair value gap, if it was me, I'd put it right above that candle. Because if we're bearish, it should not go back up into it. 6 pip stop. Lower time frame risk. Higher time frame reward. 1 to 30. Sauce. Okay. That's going to be the end of the video. I think I gave way too much sauce in this one, bro. I gave way too much sauce in this one, bro. Like, please, just do me a favor, bro. Like the video. Subscribe if you want some more real trading content, how the market actually moves. Please show me with a like, a subscribe, and a comment on what your favorite part of the video was. What's the main thing that's helped you? Please go backtest this information. Don't just take my word for it. Go see it. Go see it in the market. I'll do a couple more videos specifically on this concept. On a Forex pair, I also have a certain model that I use for futures, which implements this, but there's a couple more things to it. Just giving some more free value to you guys if you made it to this part of the video. I do have a free PDF about my specific futures model that I'm talking about. I will make another video on eventually. So if you want some free shit, click the link in the fucking description or whatever, and go download the free PDF. For now, this is all you need. Trust me, this is all you need. You don't even need to watch another influencer or another. You don't need any more information. What I told you right now is everything that you fucking need to fucking milk these markets, bro. I'm telling you right now, okay? So I got a free PDF. Click the link in the description. I also have a community and a Discord that I'm trying to build up. So if anyone is keen to be part of that, fucking join it or whatever. Message me on any of the socials that are in the description. And until the next video, we'll catch y'all.